Reading 28, Risk Management Applications of Forward and Future Strategies. Source text, CFAI 2018 edition. Summary. A borrower can lock in the rate that will be set at a future date on a single payment loan by entering into a long position in an FRA or a FRA. The FRA obligates the borrower to make a fixed interest payment and receive floating interest payment, thereby protecting the borrower if the loan rate is higher than the fixed rate in the FRA, but also eliminating gains if the loan rate is lower than the fixed rate in the FRA. The duration of a bond futures contract is determined as the duration of the bond underlying the futures contract as of the futures expiration, based on the yield of the bond underlying the futures contract. The modified duration is obtained by dividing the duration by 1 plus the yield. The duration of a futures contract is implied by these factors and is called the implied or modified duration. The implied yield of a futures contract is the yield implied by the futures price on the bond. The implied yield of a futures contract is the yield implied by the futures price on the bond underlying the futures contract as of the futures expiration. The yield beta is the sensitivity of the yield on a bond portfolio relative to the implied yield on a futures contract. The number of bond futures contracts required to change the duration of a bond portfolio is based on the ratio of the market value of the bonds to the futures price multiplied by the difference between the target or desired modified duration and the actual modified duration divided by the implied modified duration of the futures. The actual adjusted duration of a bond portfolio may not be equal to the desired duration for a number of reasons, including that the yield beta may be inaccurate or unstable, or the bonds could contain call features or default risk. In addition, duration is a measure of the instantaneous risk and may not accurately capture the risk over a long horizon without frequent portfolio adjustments. The number of equity futures contracts required to change the beta of a portfolio is based on the ratio of the market value of the stock to the futures price times the difference between the target or desired beta and the actual beta, divided by the beta of the futures. A long position in stock is equivalent to a long position in futures and a long position in a risk-free bond. Therefore, it is possible to synthetically create a long position in stock by buying futures on the stock and the risk-free bond. The process is called equitizing cash and can be used to create a synthetic stock index fund. A long position in cash is equivalent to a long position in stock and a short position in the stock futures. Therefore, it's possible to synthetically create a long position in cash if you already own the stock or you buy the stock and you sell the futures. The allocation of a portfolio between equity and debt can be adjusted using stock index and bond futures. Buy futures to increase the allocation to an asset class and sell futures to decrease the allocation to an asset class. The allocation of a bond portfolio between cash and high duration bonds can be adjusted using bond futures. Sell futures to increase the allocation to cash and buy futures to increase the allocation to long-term bonds. The allocation of an equity portfolio among different equity sectors can be adjusted using stock index futures. Sell futures on an index representing one sector to decrease the allocation and buy futures on an index representing a sector to increase the allocation to that sector. A portfolio manager can buy bond or stock index futures to take a position in an asset class without having cash to actually invest in the asset class. This type of strategy is sometimes used in anticipation of the receipt of cash at a later date, which will then be invested in the asset class. And then the futures position will be closed. Transaction exposure is the risk associated with a forex rate on a specific business transaction, such as a large purchase or sale. Translation exposure is the risk associated with conversion of foreign financial statements into domestic currency. Economic exposure is the risk associated with changes in the relative attractiveness of products and services offered for sale Economic exposure is the risk associated with changes in the relative attractiveness of the products and services offered for sale arising out of the competitive effects of changes in exchange rates. The risk of a future foreign currency receipt can be eliminated by selling a forward contract on the currency. This transaction locks in the rate at which the foreign currency will be converted to domestic currency. The risk of a future foreign currency payment can be eliminated by buying a forward contract on the currency. This transaction locks in the rate at which the domestic currency will be converted to the foreign currency. It is not possible to invest in a foreign equity market and precisely hedge the currency risk only. To hedge the currency risk, one must know the exact amount of the foreign currency that will be available on a future date. Without locking in the equity return, it's not possible to know how much foreign currency will be available. It is possible to hedge the foreign equity market return and accept the exchange rate risk, or hedge the foreign equity market return and hedge the exchange rate risk. By hedging the equity market return, one would know the proper amount of currency that would be available at a later date and could use a futures or forward contract to hedge the currency risk. The equity return, however, would equal the risk-free rate. Forward contracts are usually preferred over futures contract when the risk is related to an event on a specific date, such as an interest rate reset. Forward contracts on foreign currencies are usually preferred over futures contracts, partially because of the liquidity of the market. Futures contracts require margins and daily settlements, but are guaranteed against credit losses and may be preferred when credit concerns are an issue. Either contract may be preferred or required if there are restrictions on the use of the other. Dealers use both instruments in managing their risk, occasionally preferring one instrument and sometimes preferring the other. Forward contracts are preferred if privacy is important. Futures and forwards, as well, are virtually